Hello, fellow traders, and welcome to another installment of Forexer. Conducting a professional market analysis can be both perplexing and time-consuming, particularly if you're uncertain about which key factors to pinpoint on your price chart. In this video, we'll provide you with a concise breakdown to simplify this process. Additionally, we'll explore fundamental and advanced ICT concepts related to identifying and plotting these crucial factors and elements on your price chart. So traders, if this topic interests you, please consider giving this video a thumbs up to show your support and subscribing to our channel if you're new here. Stay tuned as we delve into the content following the introduction. Welcome back, traders. Let's dive right in. Here are the key factors that we should identify on the price chart. First, we should focus on identifying the most recent liquidity sweep areas. Second, we need to detect the buy or sell side liquidity resting zones. Third, it's essential to flag fair value gaps. Fourth, we should spot order blocks close to the current market price. Fifth, the identification of premium and discount zones is crucial. Lastly, we need to identify the general outline of the market. These factors are key to gaining insights into the market's dynamics and can aid in making informed trading decisions. So let's start with key factor number 1, identifying the most recent liquidity sweep zones. To do this, we must examine the chart and look for areas where liquidity has been recently swept. If you're unsure about what liquidity means or where to find it, please check out our liquidity and inducement video on our channel, which is linked in the description. As you can see in this example, there's a significant low that the price has breached, thereby clearing out the accumulated liquidity beneath it. This was achieved with the help of the long wick you see here, which likely represents stop orders that had gathered below that low. We then proceed to draw this liquidity sweep zone onto our chart. The second key factor involves identifying liquidity resting zones, which means detecting zones on the chart where price may potentially move to capture liquidity. As you can observe in this example, the sell side liquidity is cleared by a strong downward impulsive movement. Therefore, our goal is to pinpoint buy side liquidity on the chart. We've identified buy side liquidity at various points. Here we have buy side liquidity. Just above this high, there's good liquidity. We also see another buy side liquidity zone here. And there's an excellent liquidity zone above this swing high. By highlighting these liquidity resting zones, we have effectively identified potential areas where price may move to grab liquidity. Since price has already taken out the sell side liquidity, we can anticipate that it will rise in response to sweeping the buy side internal liquidity zones we've highlighted on our price chart. Moving on to the next key factor, fair value gaps. Before delving into the definition of FVG, it's essential to understand the concept of inefficiency. Inefficiency arises when there's an imbalance between buyers and sellers in the market, creating a disequilibrium that needs to be filled. In simpler terms, if there's a gap within the candles, we refer to it as an inefficiency. Now let's explore how to identify inefficiencies in the market. Indeed, as you can observe in the left corner, there's a noticeable gap between the candles. In such a scenario, we anticipate that the price will eventually fill this gap by returning to test the empty space. This phase is what we refer to as inefficiency. On the contrary, in the right corner where the candles are closely aligned with no gap in between, there is no inefficiency present in this case. Now, let's delve into the concept of fair value gaps and how to identify them. Fair value gaps are zones that result from inefficiencies in the market. They typically appear in specific areas where there is limited trading activity and price exhibits a unidirectional movement. Fair value gaps hold significant value in price action trading as they signify zones where numerous orders were injected, resulting in market inefficiencies. FVG can be seen as potential trading opportunities, particularly when combined with order blocks. These gaps can act as a magnet for price in the future, as they tend to attract price movement to fill the inefficiency due to the presence of many resting orders. Traders can effectively use FVG as targets for their trading entries. Let's explore how to identify a fair value gap FVGE effectively. FVG effectively formed within a 3-candle sequence and often appear on the chart as a substantial candle. The defining characteristic of this candle is that its upper and lower wicks do not fully overlap with its body. Consequently, the fair value gap zone is the area that fills the space between these wicks and is drawn on the body of the candle. For instance, during a price move downwards, A fair value gap or liquidity gap is created due to the absence of buying pressure, causing this gap to overlap with the downward movement. The key to identifying fair value gaps lies in considering the gap only within the impulse up or impulse down candle, as well as the candles immediately adjacent to it. Other candles do not contribute to the calculation of this gap. These pockets of liquidity are crucial and can serve as strong entry points, given that the market is often drawn to liquidity. This means that when the price is planning to move downward, it aims to sweep the potential liquidity zones above it. As a result, FGs represent areas where the price may rise, and after testing them, it may continue its bearish movement with even more strength. Now, let's navigate to the price chart and pinpoint the fair value gaps. Currently, the price is situated here, so our focus should be above this level as we seek to identify fair value gaps. We have identified a fair value gap right here. There's another fair value gap in this location. Additionally, we can consider this zone as a fair value gap. So we found 3 fair value gaps above the current price. Price action could potentially move up and interact with any of these gaps. Furthermore, we've also spotted a smaller fair value gap here, and another one can be observed just at this point on the chart. It's generally advisable to mark up fair value gaps, especially those in the vicinity of the current price. Ignoring these gaps in our trading system could potentially lead to losses. Now, let's proceed to the next key factor that we need to mark up on our price chart. Now, let's move on to the 4th key factor on the price chart, which is identifying order blocks near the current price. Order blocks are significant and optimized supply and demand zones that encompass a substantial number of buy and sell orders. When the price approaches these order blocks, it has the potential to change its direction to the opposite way. Let's explore how to identify an order block on a candlestick chart. In a bullish scenario, you can detect an order block by looking for the last bearish candlestick just before the beginning of a strong bullish movement. Alternatively, the first weak candlestick before a significant upward movement can also be considered an order block. However, for an order block to be valid, the recent market structure must be broken. This same concept applies in a bearish scenario as well. So in essence, an order block is identified based on specific candlestick patterns that signal a shift in market sentiment and direction. Indeed, on the price chart with a closer look, we can readily spot these order blocks where prices hit and reversed from them. Additionally, there's a perfect order block located near the fair value gap and liquidity resting zone. Let's now proceed to explore the next key factor on the price chart. The next key factor to focus on is identifying premium and discount zones on the price chart. Premium and discount zones are essential for setting up high probability trades. These zones represent the best areas where we aim to increase the probability of successful trades. To determine if the price is within a premium or discount zone, we often use the Fibonacci tool. When the price is within the discount zone, it's considered an advantageous area for buying. Conversely, when the price is within the premium zone, it's an ideal region for selling. Additionally, we can leverage premium and discount zones to identify valid order blocks and fair value gaps for trading purposes. These zones provide valuable insights for making trading decisions with a higher probability of success. For instance, in a bullish market, trading the bullish order blocks situated within the discount zone can significantly enhance our trading strategy and minimize potential losses. This approach capitalizes on favorable conditions in the market and aligns with the overall bullish sentiment, increasing the likelihood of successful trades while minimizing risk. To determine whether the price is in a premium or discount area, we can use the Fibonacci tool by connecting the swing high and swing low of the price. The zone located below the 0.5 Fibonacci level is known as the discount zone, while the zone above the equilibrium line is known as the premium zone. These zones are only reliable if there is an impulsive movement that breaks the recent structure. To draw the premium and discount zones in a bearish scenario, the Fibonacci tool is applied from the start of the impulsive movement to the end of it. The same concept applies to the bullish scenario. Certainly, based on the bearish impulse movement on the chart, we can add the premium and discount zones using the Fibonacci tool. We draw the Fibonacci tool from the high of the movement to its lowest point. Then we draw a line from the Fibonacci tool's 50% level. The zone below the equilibrium level is known as the discount zone, while the upper zone is the premium zone. Therefore, when the price is below the equilibrium level or in the discount zone, it is advisable to take long positions. Conversely, when the price is in the premium zone, which is considered expensive, it is recommended to take short positions. It is important to note that long positions should not be taken in the premium zone. Moving on to the last checkmark, our final key factor is analyzing the general outline of the market. This entails spotting the market direction and structures that evolve within it. In the example here, it's evident that the price was in a strong uptrend. However, a shift in market structure is occurring as the price fails to establish a new higher high and breaks the higher low to the downside. Despite this shift, we notice a sell-side liquidity pool that's been swept by the market. This combination of factors signifies a change in market character. There's a high probability that price will move to sweep the buy-side liquidity before turning bearish. Although the market structure has changed, we can still claim that the price is generally in a downtrend. What we'd like to see is the price rising above the 0.5 Fibonacci level and entering the premium zone, which would provide us with an opportunity to enter a short position. With all these key factors added to our price chart, we have the necessary tools to thoroughly analyze the market. Indeed, you can observe that the market structure has undergone a significant change in the 4-hour time frame. Consequently, we are anticipating a bearish price movement. If you zoom in on the lower time frames, you can already discern that sell-side liquidity has been swept. Moreover, during the process of sweeping liquidity, the price has generated 3 fair value gaps. Among these 3 fair value gaps, the most significant one is the fair value gap located in the premium zone. This particular gap holds greater importance for 2 reasons. Firstly, it is situated in the premium zone, indicating it's considered an area where the price is relatively expensive, making it an attractive zone for selling positions. Secondly, there's a substantial liquidity resting zone just below this fair value gap. This combination of factors makes it a crucial area to monitor for potential trading opportunities. Given that the price has already swept the sell-side liquidity level, I anticipate the price to rise further, potentially sweeping the buy-side liquidity level and possibly continuing its upward movement until it reaches the fair value gap zone. After filling this gap, there's a possibility of a reversal, followed by a continuation of the bearish movement. In preparation for this scenario, we can employ ICT trading strategies and patterns to take short positions from the fair value gap zone once the price reaches it. This approach aligns with the anticipation of a reversal in price direction after filling the gap. In the upcoming episodes, we will delve into and optimize a range of ICT trading patterns and strategies that will undoubtedly enhance your trading system and significantly improve your win rate. So stay tuned for that. Traders, if you enjoyed this video and would like us to continue creating more videos week after week, please click the subscribe button and activate the notifications bell. Also, feel free to share your opinions and suggest topics you'd like us to cover in the comment section. We'll do our best to create more informative content for you. Thank you for watching, and we look forward to seeing you in the next episode.